You're listening to a Mint podcast brought to you by HT Smartcast.
Would you like if your employer pays premium on a savings life insurance plan on your behalf? A savings life plan is the one in which you get the maturity benefit if you live through the insurance policy period, and if something happens to you during the policy period, then the family receives the death benefit. So this savings life plan can be an additional benefit for you over and above the salary that you receive from the employer. A few employers do it for their key employees so that employees have a reason to stick to the company for the long term, while others are doing it purely to save taxes. Hello, I'm Aprajita from Mint Money and you are listening to Why Not Mint Money podcast. In today's podcast, I'll tell you about how a few small business owners are taking advantage of a tax loophole that benefits the company and the top management both. I'll also tell you about the right way employers can provide savings life plan or internal life insurance to their employees.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
First, you need to know about the key man life insurance. Key man insurance policies employers buy for their key managerial persons, meaning those employees who are critical for the company operations. If they are not around, it will be a loss to the company. Since employers buy it for their own benefit, they become the proposer and premium payer both in such policies. The proceeds go to the employer itself. The premium that the employer pays is not taxable in the hands of employees on which the key man policy has been taken, because the employer is the proposer, or you can say owner of the policy. Insurance regulator IRDAI has specified that only term insurance policies can be sold under key man. Now, the second type is employer-employee insurance schemes, in which the proposer or owner is the employee himself, but the employer pays the premium on behalf of the employee. So this is the kind of policies that can benefit employees at the mass level. This premium will be taxable in the hands of employees as perquisite. This type of employer-employee insurance construct can have term or savings life plans both. The maturity amount in this case goes to the employee and death benefit to the employee's family, because employee is the owner of the policy and employer is only paying the taxes. So be it maturity benefit or death benefit, it will directly go to the employee or employee's family as the case may be. Now, what's in it for employers, you ask? Well, they can claim tax exemption against premiums paid under both the types as business expenses. So be it key man policies or employee insurance schemes, in both cases, the premiums that the company is paying, they can claim tax exemption against those as business expenses. Now coming to the third type. This is where things get interesting. Industry players call it employer-employee insurance solutions. It works like a key man policy, meaning the premium payer and the owner of the policy is employer, but they are selling savings life plan in these schemes. And remember, I earlier told you that IRDAI has specified that only term insurance policies can be sold under key man, not savings life plan. So somehow, industry players have found a way out to sell a key man life insurance policies in which underlying policy is a savings life plan, not a term plan. So employer remains the owner of the policy and pays the premium, but it promises to assign this policy later to the employee. It says that instead of taking additional salary that will get taxed upfront, you allow us to buy an insurance plan for you. Since employer remains the proposer, premiums don't get taxed as perquisite for employees. Once the premium payment term is over, employer can assign it to the employee, and now the maturity amount will go to employee and will be taxable for him. If they don't assign it to employee, the proceeds will go to the company and get added into business income. So what companies do it, they buy it in the name of employee, and then when the policy matures, then the maturity amount comes to the company Then with that maturity amount, they will again buy these kind of policies, and that is how they can claim tax exemption against the premiums paid, and that is how tax can be deferred for perpetuity. Some business companies are doing it. Interestingly, small businesses buy such plans for their family members or directors who have stakes in the company. Instead of withdrawing salary, they deploy company profits for personal use like this and get double tax benefit. One, tax exemption for the company on corporate tax against premium paid as business expenses. And second, saving upfront tax on salary, because if you get your salary, then you will have to pay tax on it as per your income tax slab rate. And top management owners, they come from 30% income tax slab rate. So 30% upfront tax reduction will be there if they withdraw it as salary. But if they will take it through this policy, the savings life policy, then it benefits them because those premiums are not getting taxed as perquisite in their hands. Now, the correct way is to buy it for lower and mid-level employees also. This can be a great tool for employee attraction and retention. It can be pitched to employees as a social security benefit that company is securing their future. Doing it under employer-employee solution construct could be questionable though, because if the employer is the owner of the policy, it becomes a key man policy under which only pure term plans can be sold, as I told you. So insurance regulator and income tax department should take note of it, whether these kind of policies can be sold or not. But what employers should do is they can buy either savings life plan or a term plan in a group insurance construct, the way they do it for medical insurance, so that neither premiums nor maturity amount gets taxable in the hands of employees. This is the best way to do it. But somehow industry has found a way out to sell key man policy having a savings element. So insurance regulator and income tax department should take a note of it. I know today's podcast turned out to be a bit complicated, but I suggest that you listen to it a couple of times so that you are well aware of what new is going on in the industry. Feel free to ask me your queries related to this topic. My X handle is Apri_Sharma. You can search my full name Aprajita Sharma on LinkedIn to find my profile. I'll come back soon with more such interesting podcasts. Till then, keep listening to smartcast.com. Now a good news. Smartcast is taking its first step towards honoring and glorifying the community of podcasters with the most awaited event of the year, Smartcast Admin presents Podmasters Conclave and Awards. Get set for a day designed for you and your team as we celebrate brilliant minds in podcasting. Nominate your podcast to win awards and recognition, expand your audience and network, and meet industry legends and potential collaborators who will take your podcast to the next level. Time is running out. Visit any of the social media platforms of Smartcast to check for rules and criteria and nominate your podcast now. Thank you.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.